Hi there, I'm Tyler Ballhorn. This is the Stockscores Market Minutes for September 27th, 2013. This week, I want to talk about stop loss orders. Good traders know that it is important to limit the size of your losses. With that said, in this market, it is usually not a great idea to use an actual stop loss order. What has happened over the last few years is the computers have taken over and they have driven out the human market maker. The human market maker's job was to provide liquidity when there was an absence of liquidity. But because the computers have taken over that area, we no longer have that human being there to make a market and reduce the slippage that happens in particular bid-ask spreads between the bid and the ask on stocks. And so as a result, when you have a stop loss order execute, you can get a very bad fill. And in fact, what we often see is stocks drop very quickly because a whole bunch of stop loss orders are triggered at once. There's no market makers there to pick up the slack, and the stocks suffer these big declines and then soon after bounce back once all these stop loss orders have been triggered. So I would say to you that unless a stock is extremely liquid, it is better to manually execute an exit order when a stock is breaking through an important support price. Now, this leads to another important factor. We should set our stop losses around important floor prices on the chart. And if the stock goes through that, well, then we have to watch that stock very closely and make a judgment about whether the stock is likely to bounce back in the short term or whether the breakdown is the sign that something is wrong in the fundamentals of that company. Now, what I have noticed in the last year or so is that many stocks will test their support and then bounce back after maybe going through it for a very short time. And that is why it's better just to manually execute that exit order. And I often use this concept of exiting if the stock closes below support. And then if the following day it can't make a bounce back, then I'll exit those stocks because the market has told me something is wrong. But what I don't want to do is I don't want to exit good stocks simply because of a lack of liquidity and a large seller comes in, makes the stop trigger because the stock drops real quickly and then it ends up bouncing right back. So for the most part, most stocks, I would not use a hard stop loss order. Instead, use this concept of manually executing the exit once the stock has shown a breakdown. All right, here's a chart of the S&P 500. We've been in pullback mode for a little over a week. I think that will continue for another week, at least. I expect that the market will come back to that green line before it bounces. And so although we've had, I think 5 or 6 out of the last 7 days down, I do think we have some more down days ahead. That's good though. It recharges buyer interest, it shakes out weak hands, and then the long-term bull market can resume. So in the short term, I would remain relatively cautious, but longer term, that bull trend is in place, and so we should stick with it until that green trend line is broken. The TSX is consolidating underneath resistance. I think it too can make that break through resistance and continue to build on the optimism that has started to build over the last few months. You can see the rising bottoms on the chart of the TSX, but until we get that breakout through the red resistance line on this chart, I wouldn't get too excited about Canadian stocks, but because these stocks are testing that resistance, we certainly have the potential to see a strong technical break very soon, and I'd keep an eye on this market. Of course, I'll be doing that every week with this video. The Treasuries broke the downward trend line as I thought that they would. In the last couple of weeks, I've been talking about how Treasuries looked a little bit oversold, how they were likely to bounce back. It certainly didn't hurt that the U.S. Federal Reserve opted not to cease or taper off some of their bond buying that they've been doing every month. Of course, they've been doing $85 billion a month, and that is not ending yet or not even slowing down yet, and that is supportive for Treasuries. I don't see considerable upside potential simply because we're fighting a downward trend. We're fighting into that pessimism, but I think this market will stabilize and stop going down if nothing else. The China market got a little overextended to the upside after 3 months of solid upward moves. It really ran ahead of itself. We're now correcting back out of that. I expect we could see another week or two of down markets in the emerging markets, China in particular, before we bounce back. but I do like how this market is shaping up. And if we continue to see the optimism build, this is going to be particularly good for commodity-based markets like the Canadian market, which tend to correlate more to the Chinese market and the emerging markets than anything else. Emerging markets here also, you can see that big spike higher when the Fed did not taper, and we've basically been profit taking since then. I again think we could see a little bit more. There's some real short-term, relatively minor support at the green line that I've drawn, but I think we could go all the way down to 40, even 39.5, and still remain healthy on the emerging markets chart. What will be important is that we break that downward cycle of falling tops, which I've identified with the red line, and that's going to take some time, but we do see this gradual ending of the bearishness in emerging markets, the bearishness in the Chinese market. Things are stabilizing, starting to improve, and that's going to be good for stocks globally. U.S. stocks is going to be good for because so many U.S. listed multinationals, the big companies on the New York Stock Exchange, for example, have business all over the world, and they're going to benefit from an improving global economy. Of course, it also helps the Canadian market because as the global economy improves, there's more demand for commodities, which of course Canada is definitely long of. US dollar continues to be weak, but it is at pretty important support. Look how many times the market has bounced off of that green line in the last year. 1, 2, 3, 4, 5 times. We're now in the 5th time right now. So it should bounce from here. It's a little oversold. I think we'll see that bounce back, and that could be a little bit harmful for some of the commodities in the short term. Now gold, despite the weakness in the US dollar, really can't do anything strong. It still hasn't broken that downward trend line. We do see a little bit of optimism building. I've highlighted that with the rising bottoms, the green line that I've drawn across those rising bottoms there. And that is a positive, but when you consider how weak the US dollar has been, I would expect that gold would be stronger than it is. So it's not doing as well as it should, and that tells me that the bears are still in control of gold. And I'm not going to get too excited about gold until it breaks that downward trend line at a minimum. Oil market has been slipping lower as tension in the Middle East dissipates. Not only is the Syrian situation less hostile, I guess, but we've also got some, thawing of the relations between Iran and the U.S., and those things are causing a pullback in oil. But I do think we're at support here, and we've got a conflict. In one hand, you've got things cooling off in the Middle East, but you've also got a global economy that is slowly improving, and I think we could see a bounce in oil in the near term, more so on the improving global economy story, which should continue to develop in the months to come. And finally, the chart of the VIX, or at least the ETF that represents the VIX, the VXX, continues to be in a downward slide. The tops are falling faster than the bottoms, and that is a sign that the sellers are getting a bit tired on the fear side, on the VIX side. And so we could see a break of that downward trend line. We're certainly trying to do that, but gosh, when you think about this chart over the last couple of years, it's just been a constant taking away of the fear. The headline risk is dissipating. That's great for the stock market. So, unless you're long the VIX, it's really a good chart to see this thing going lower. All right, so I'm neutral on U.S. stocks, really bullish long-term, short-term kind of negative. That's why I've put a neutral rating there. Neutral on Canadian, but I do like the optimism that's building. We just need that breakout. Bearish on gold until the downward trend line is broken. And neutral on oil as it is sort of trading sideways in that range. Should bounce in the short term. I think that U.S. stocks have a little farther to fall before they hit the trend line support, where they will likely bounce. The Canadian market continues to fight with resistance, but it is showing improvement. And as I said, gold needs to break its downward trend line, and oil should bounce in the short term. Well, that has been the Stockscores Market Minutes for September 27th. Have a great week in the market and trade well.